it's all about the big banks and big corporates. They're doing huge amount of buybacks. And they are the only two entities which are propping up the market. So what a buyback is basically all these blue chip companies on the stock market, like, or in the S&P 500, they have shares issued to the public, right? And what they're doing is, at the moment, interest rates are like absolutely zero, if not negative, depending on where you are. And it's really easy and cheap to borrow money. So they're thinking, wait a minute, let's just buy back all of our debt. So it's basically a debt consolidation in the basic form. So they're like, okay, borrow a whole load of money for free, pay off all of our debt, and then, yeah, and let's buy back all of our shares. So I've put it in pictures because I'm a simple person. I can only understand when things are in pictures. So big corporate company or a bank, let's say they're making $1 billion per year in earnings. So there's two things that they really care about, which is their earnings, their EPS, earnings per share, and also their dividends. So let's say they have 100 million shares outstanding into the public domain. That's 100 million shares. And so let's just say that, so basically it's 1 billion divided by 100 million equals $10 per share. So all they care about is dividends and EPS. So what they're doing is like, okay, well, let's just beef up our numbers, because I'm pretty sure that, I mean, most of the people in the banking sector are pretty oblivious to what's going on, but there has to be some people, like the higher echelons of the bank, knowing, right, our game is up at some point, so let's just milk this cow before it rolls over. So what they're doing is like, okay, well, how about we just borrow loads of money, or even use our huge surpluses of cash, like Apple and whatnot, and just buy back some of our shares. So let's say they buy back half, so there's now only 50 million shares outstanding, so look what happens to the EPS, it goes up. So they now have a $20 EPS. And you're not supposed to read this slide, but this is basically in statements from all the main big banks, from Goldman Sachs to Bank of America, etc. And all these things which I've highlighted here says quarterly dividend increase, hike its quarterly dividend, hike its quarterly dividend, dividend hike, hike its all the banks are hiking up their dividends by sometimes 50%, which is nuts. So it does sort of paint a picture. I'm not saying this is the whole story, but all I'm saying is that it's these buybacks which is just pushing the market up, which is why there's no volume, but the market's still rising. So this takes us back to this page, so this chart. So here, this is basically the outflows, so quarterly fund outflows, which is, you know, that decline. But look at this, S&P 500 buybacks. They're buying back as much as they did back in 2007. So, I mean, again, I'm not saying it's going to hit this sort of resistance line here and then bounce off, but again, it's just another indicator. You have to be aware that coincidence does not equal correlation. So, but mind you, after a certain amount of time where there's so much compelling evidence, I mean, surely there's got to be some sort of causation going on there. So again, this is going back to one of the other, this is the volume chart again, and I've plotted all of the recessions since 1950. And what I've done is I've basically measured the distance from the end of a recession / a stock market crash to the beginning of a new one. Any guesses what the average is? How many years? 8, yeah. So I've always said 8 to 10 years between each crash and whatnot. So these are all the times, and the average is actually 6.11 years. So there's, from the end of the last one, but obviously it's hard to really pinpoint the end of a recession. So I would say 2009 was the end of sort of the last one. So where does that leave us now? Again, there's nothing saying that this could not go on for another 10 years or so, but I think it's highly unlikely that, I mean, we should see another sort of pinky column at some point soon, which would be a nice profitable event for me. So, yeah. So, in answer to sort of the question I'm being asked a lot is, am I still rock solidly sure on all of this? I'm all in.